Hey friends, I am back with another video. This is going to be my third trading strategy that I want to share with you guys for options trading. I am currently in Tokyo. I just got here a couple days ago, staying at a friend's place and looking forward to all the people that I know here. I love Japan. It's just a really unique place. Anyway, as I said, so this is going to be the third options income trading strategy that I share. But before we go into it, I thought it'd be worth doing a brief recap of the first two strategies. And also, before we begin, as always, standard disclaimer, please take a quick read if you haven't seen it before. And if you have any questions, let me know. Okay, so the first strategy that I shared was the put credit spread. And that looks like this, where you're selling a put, it's like selling insurance below the market. This is where the market is right now for the SPY. So you're selling below the market and then you buy insurance further out. You buy a put further out to cap your risk. And it caps your margin. This is how much margin your broker will require of you for this position. So like all option selling trades, the idea here is that you're capturing that insurance premium, like an insurance company. There's a variance premium. But with a put credit spread, you also have a directional exposure to the upside. Put credit spreads make money if the market goes up. Like if you're an insurance company, you don't want the market to go down because you don't want to have to pay out. So there's a bit of a directional bias here. Now, some traders just prefer to have the options premium. Theta is the theoretical return per day here at the market. They prefer to just have the premium and not have this directional exposure. So that leads way to what we call delta neutral strategies. Now, the second strategy that I shared is called an iron condor. And this combines a put credit spread like this one with a call credit spread, which also has options premium and it has a directional bias to the downside. And when you put these two together, you have options premium in the trade, but your directional exposure for normal moves up and down is pretty much flat. Delta is minus 0.59. That's like half a share of SPY. You can never get it perfectly to zero, right? And there are reasons why you might want to carry a little bit of negative, but that's a future discussion for us to have. And over time, profit will accumulate in the trade. And just a reminder of what that looks like. These are 7-day steps, so these are 1 week per line. And this is the theoretical P&L. So as time passes, if the market stays around this value, you can see here, you can see the profit kind of trickle into the trade, right? Week by week. Now you can place these iron condor orders as a single order. It's the exact same position, just what it looks like as a single order. So, and it goes on for credit. And these are always times 100. So this is $254 coming in. The iron condor is delta neutral because if we add up the delta that is listed on each of these options, right? So if we come over here, you can see the delta for each option. So if we were to add up the delta of each of these options times the quantity, it would net out to zero or minus 0.6. But an iron condor isn't the only structure you can put together that has that effect. You can build other strategies that are delta neutral as well. And today's strategy is going to be one of them. This one is called a broken wing butterfly. Broken wing butterflies don't have to be delta neutral, but many traders trade them that way. So with a broken wing butterfly, you have you sell two options at the same strike, and then you buy an option on either side of that strike, all the same kind. In this case, put options. If these distances are the same on both sides, that's just called a butterfly. The broken wing butterfly name comes in when we change one of these sides to be narrower. So now the wings are different lengths. This is called a broken wing butterfly. Now, option traders who trade these broken wing butterflies the way that I like to do it, usually they'll put these shorts a bit further below the money, and you might use deltas to pick these strikes. So just like with the iron condor, if we look at the deltas when we pick our strikes, we can get that delta close to zero, which is where we want it. So let's go ahead and do that. So a very common approach for these is to use the 60, 40, and 20 delta. So we're going to pick our strikes, right? So this is a minus 60 because I'm going to buy one. So 1 times minus 60 is minus 60. Then I'm going to sell two of the 40s. And they're minus 40 each, but I'm selling, so it's plus 40. And there's two of them, so it's plus 80. Sell, sell. Right, so minus 60 plus 80 now, we're at plus 20. and I'm going to buy the 20 put, which is a minus 20. 1 times minus 20, minus 20. 20 minus 20 is 0, right? So all adds up to 0. You don't have to do the math every time, just 60, 40, 20. Those are your strikes, right? And if we analyze this, it'll be delta neutral. Okay, minus 1. That's basically 0 as far as we're concerned. Now, this 60, 40, 20 selection that was popularized by a trader named Andrew Falde. He partnered with SMBU, and he's got a video course if you want to look at his deep dive into BWBs. I haven't taken his course, so I'm only sharing stuff that like I've seen publicly. But there's nothing magical about 60, 40, 20. That was his preference. You could do any combination that adds up to 0, right? So you could do 50, 35, 20. You could do 39, 26, 13. And there will be trade-offs in terms of where the butterfly shows up, where it makes money, how much risk you have to the upside. But if you make the deltas match up to 0, they'll all be delta neutral. So here's that T plus 0 line, and it's nice and flat anywhere near the money. Now, as a refresher, here's that iron condor, and it's also flat near the money. But these trades work very differently. I think of the BWB as delta neutral, but not direction neutral, because to the upside, the risk is very limited. All of the risk is really thrown to the downside. Plus, if the market heads down towards the downside, it's passing through this large profit tent area. So if it happens later in the trade, that can be totally fine. And maybe you just cut the trade and probably get a profit on it at that point. So while they're both delta neutral, if I'm worried about a runaway market to the upside, I'm much more inclined to trade a BWB than an iron condor. So with an iron condor again, market drops off pretty hard on the upside.
Hey guys, just taking you around outside Japan and having a great day. If you like the video, please hit subscribe, hit the like button, and anyway, now back to the video.
Now, I also want to note that as an all put structure, our BWB ends up going on for a debit. The previous trades that we looked at would go on for a credit. We would get paid money to put the trade on, and that felt very natural. And there's a tendency to think of the credit as the options premium, as the source of the edge in the trade. But that's not really true. So just do note, for example, the expiration line is well above us here, and this over time, this line is going to creep up towards it. Even if you're out here, you'll get a little bit of that splash over. So for example, here's our weekly lines again. I'm just going to zoom in, and you can see over time, yes, we put it on for a debit, but over time, the P&L is going to go up, and we'll sell the trade for an even bigger price than we put it on for, and we'll make money if it stays in this kind of area here. If it heads out to the upside or downside, certainly we can have losers. That brings us to management. Okay, I recommend putting these on 60 plus days to expiration. So this is the 20th of October. I like to use the monthlies. It's 67 days to expiration. So that's 60 or higher. Now, in the case of the Iron Condor, where it went on for a credit, I was recommending that you take profit if you get half of that credit in profit, right? So if you put this one on for about $250, if the trade was up $125, close it and take the money. That's fine. With the BWB, you don't really have that kind of clarity, I guess I would say. Really what you want to do is just hang out in the trade as long as you're kind of in this sweet spot. A lot of people will just track this delta of this center strike as their indication, right? If the market gets too far away from that center strike up into here, then you don't want to be in the trade anymore. And if the market gets down here really close to the big risk, you don't necessarily want to be in the trade anymore. And the way people will track that is they'll just say, okay, well, if this center strike is at 40, right, when we put it on, as long as it's between 30 and 50, we'll stay in the trade. And that's an arbitrary number. You could use something else. You could go, if this is a 35, maybe you want to use 43 and 27 or something like that, right? But some sort of a range of delta that you'll accept for this trade. And I would just check once a day. I wouldn't be staring at the monitor all day, like, does it move? Waiting to see. That's kind of the point of options income trading, is this should be something that you can do. And, maybe you still have a job, or maybe you do work online, or maybe you want to go sightseeing or spend time with family and friends. And in addition to that delta exit, I would also have an exit based on days to expiration. So we put this on, this one's at 67 DT. If we got down to 14 DT, I would certainly just get out of the trade at that point. We have a couple of recent back tests I did. for this strategy. Ender Falde called it the net zero. That was his name for it, if you want to Google that. Both of these are going with a 60-40-20 structure using SPX, but SPY is the same as SPX. It's just 10 times smaller. There's some tax advantages in the US of trading SPX as well. So when you get comfortable at that size, I do recommend it. Anyway, this is 60 days to entry or longer for the expiration. It would get in, and then it would bail out at 14 days to expiration if we were still in the trade. Otherwise it was using that delta exit. And as soon as it got out of the trade, it would just find the next expiration cycle that was 60 plus days to expiration, and it would put a 60-40-20 on there and just continue over and over. And now if I jump over to the 45-day to expiration, it's a lot choppier. So we're getting in at 45 days to expiration, and we're holding as close as 7. A lot of option traders, especially in the beginning, they're attracted to these shorter durations because they think, oh, look how much higher the theta is. They feel like they're being more aggressive, so they'll make more money. Well, this one actually makes less money, but generally it's a bit choppier, but still it is very profitable. Both of these are very good equity curves if you can combine them with other strategies. Okay, so that's the Brooklyn Butterfly. I really like it. None of these three strategies is inherently better than the others. So, if you're happy with put credit spreads, or if you like iron condors, or if you want to trade a mix of these, even better. They're all great. They're different in different ways. They all have options edge. I believe they all make money over the long term. And I'm going to share some more strategies in the future. I'm going to be moving into time spreads, and then I'm going to start talking about complex spreads, which is more like how I currently trade. So if you want to see those, hit subscribe and be sure to hit that little bell icon. If you like the video, hit the like button. Really helps out. And I will see you next time. I'm gonna go enjoy Tokyo. I'm so happy to be here. I can't even. Anyway, see you guys.